Thursday, March 19th, 2026. The moment global trading floors opened, a massive, synchronized wave of selling hit the markets, points in a single session. The selling quickly crossed the Atlantic. Looking at the European indices, Germany's DAX fell by over 300 points in near lockstep. This headline explains the first trigger. Iranian retaliatory strikes caused extensive damage to Qatar's Ras Laffan LNG plant, a critical node in the global energy supply chain. This commodity tracker shows the immediate fallout. Brent crude surged past $111 a barrel, dealing a massive blow to oil-importing economies already struggling with inflation. The second blow came from the U.S. Federal Reserve. Chair Jerome Powell held interest rates steady at 3.5 to 3.75%, taking a strictly hawkish stance. Hawkish means the central bank is prioritizing inflation control over economic growth, usually by keeping borrowing costs painfully high. Geopolitical conflict choking off energy, combined with central banks refusing to lower interest rates, created a perfect storm for investors to flee. But those global conditions still don't completely explain the absolute collapse that hit the Indian stock exchanges that same day. In Mumbai, the sell-off was historically severe. The benchmark Sensex completely gave way, dropping over 1,800 points, while the Nifty 50 crashed below the 23,200 mark. The primary downward pressure on the Indian market came from within its own financial sector. This logo represents HDFC Bank, the country's largest private lender, which saw its market value crater by nearly 9%. A single resignation letter terrified Wall Street and Dalal Street alike. This collapse occurred independently of traditional financial triggers, like missed earnings or loan defaults. A severe leadership crisis inside one foundational institution acted as the final spark, turning a highly anxious global trading session into a localized financial disaster. The boardroom of a multi-billion-dollar bank is a fragile ecosystem. Its entire valuation relies heavily on the public perception of absolute stability and flawless risk management. That perception shattered when Atanu Chakraborty, HDFC Bank's part-time chairman, suddenly announced his immediate departure. The damage was entirely in the phrasing. He formally stated that certain bank practices were, quote, not aligned with his personal principles and ethical standards. Financial markets are giant calculating machines. When faced with quantifiable bad news, like a sudden tax hike or a known quarterly loss, traders simply adjust their spreadsheets and reprice the asset. They don't panic. But when a chairman suggests hidden ethical failings, the math stops working. This is governance uncertainty. Institutions dump the stock immediately because there is no formula to calculate the depth of unknown internal rot. By leaving the exact nature of the ethical breach ambiguous, the resignation weaponized the unknown. It proved that markets will punish a lack of transparency far more severely than a bad balance sheet, turning a localized dispute into a severe crisis of institutional trust. To understand how one bank forced an entire country's stock market down, we have to look at index weightage. Index weightage is a mathematical rule where larger companies exert a proportionally bigger influence on the overall market average than smaller ones. HDFC is a structural giant. Due to its massive market capitalization, it acts as a foundational pillar holding outsized dominance. When HDFC suffered an isolated 9% cratering, its mathematical gravity forcefully dragged down the entire financial sector, pulling clean banks down with it. That mechanical downdraft triggered algorithmic selling and widespread human panic. The India VIX, a metric that measures the market's expectation of near-term volatility and fear, spiked by over 15% in response. Index heavyweights are effectively double-edged swords. Their massive size provides deep, reliable stability during bull markets, but they create inescapable mathematical contagion when their internal management fails. The global shocks of March 2026, the tech sector's anxiety over massive AI infrastructure spending, and the persistently high interest rates set by the Fed are cyclical. Markets eventually adjust to them, but a break in institutional trust leaves long-lasting, permanent damage. This currency ticker shows the compound effect of the day. The combination of global flight to safety and massive domestic banking instability actively weakened the Indian rupee, pushing the exchange rate above 93 to the dollar. It all comes down to the governance premium. This is the invisible, extra financial value awarded to a corporation simply because investors implicitly trust the ethical compass of the people running it. The moment internal whistleblowing shatters that premium, the underlying asset is completely repriced. No amount of robust capital reserves or favorable global tailwinds can stop the immediate bleeding. The crash of March 19th laid bare a terrifying mechanical reality. A few carefully chosen words doubting corporate ethics inside a boardroom can be just as violently destructive to a nation's economy as a missile striking an oil field.